Hello everyone. So yeah, as Jen says, today we're looking at options C and D of NECs 3 and 4. So if you attended last month's seminar, which is the first of this season, we were just looking at a high level review of NECs 3 and 4. So you will know that the reasons we're looking at 3 and 4 are that they're the contracts, they're the versions being used at the moment. Probably more 4 now than 3, but we're still seeing options 3 being used. So if we can go to the next slide, I think, please, Jan. And the next one. Lovely. So yeah, we're looking at options C and D. As always, we're looking at some of the procedures relevant to C and D because NEC is a procedural contract. It's something you've got to operate whilst you're carrying out the works. We'll be looking at, so C and D is the pain gain sharing, the target cost contract. So we'll be looking at how we set the pain gain shares, how we set the target, and also the impact of compensation events. So if we can move on to the next slide, Jen, please. So if you were here last month, we looked at this slide, so I've replicated it, and you can obviously see option C and D, the ones we're looking at today. So just a brief summary as to the others. Essentially, option C and D, it's about pricing the contract. We can sort of remove option F from our options here because that's a management contract. So we know what that is. So then we're left with options A to E. A and E are pretty much polar opposites. A is fixed price. The way we show the fixed price in this contract is through the activity schedule. So we looked at that briefly last month. So it's basically a list of works that are going to be carried out with pricing and the total at the end. So the total is the fixed price. The activity schedule is relevant only as regards getting paid for the work. It is not relevant to the type of work that's going to be carried out because that is set out in the scope or in NEC 3 in the works information. Option E, cost reimbursable contract, is what it says it is. It is priced, so it's not just a sort of free for all, I can claim whatever I want. It's priced by reference to the schedule of cost components. We're going to be looking at that, I think, in about March 2026. And the schedule of cost components is basically a shopping list of items that can be claimed, and also the sort of checks and balances on what can be claimed, what can't be claimed, to ensure that the mechanism is operated fairly. Option B is a sort of hybrid of option A, so it's a fixed price but with a bill of quantities. So you've got a little bit of a small allowance for remeasuring in certain circumstances. So predominantly it's fixed price, but with a little bit of wriggle room. As with option A and B, as with all fixed price contracts, the price can be increased, which might sound a bit counterintuitive. But of course, what if the client, the paying party, requests some additional work to be done? That would increase even though it's a fixed price. And we have a slide later to explain that is basically an NEC called a compensation event, which covers changed works, extra time, and the money relating to that time. So option A and B can increase as a result of compensation events. Slightly academic with option E because, of course, you're getting paid as you go along. So back to option C and D, the topic for today. They're sort of a mashup as between options A and B and option E. So it's a target cost contract, so you have a target, and carry out the work, and as you go through the project, you get to completion, and then there is a calculation done to work out what's been paid as regards the target. If what's being paid is under the target, happy days for everyone, because the difference between what has been paid and the target is a gain share to be shared between the two parties according to the contract, in proportions relating to the contract. If we have the reverse situation where what is paid is more than the target, then sadly we're in what I would call a pain share situation, where the parties are having to distribute the excess between them, again in accordance with what the contract says. So we're going to be looking at all of these things, where that is in the contract, how it works, as we go through today. But option C is a target contract with an activity schedule. So that basically the target cost is the activity schedule. So basically it's similar to the fixed price in option A, where we also have the activity schedule. So that's the target cost. And option D, exactly the same, but the bill of quantities, as we see with option B, where it's the fixed, the target. Again, as with option B, there's a little bit of wriggle room if any element of remeasurement is required. So that is where we get the target from. So clearly the target, and this is pretty obvious really, will be incorporated into the contract, and that is obviously pretty critical. So if we can move on to the next slide. And what I will say is we will come back to option E, reimbursable, because that is effectively how contractor or subcontractor gets paid as they carry out the work. So on a month-by-month basis via their interim payment applications. So this is, generally a construction contract would be a design and build, not always, but the way that NEC is set up is that it can be either. So as with lots of issues in NEC, there are bolt-ons to include the design element. Now it says that option C and D are alternatives, so that's not quite correct in that context. What it's supposed to be is that ordinarily you would have a design and build on a fixed price, so an option A contract. And what I would say is, up until recently, the option A fixed price was the most popular NEC contract. Recently, we're seeing far more, certainly option C's, not so much option D, but they are now being used. And as it says there, the aim is that instead of having a fixed price in which it's sort of the contractor either takes all the losses or takes all the gains, the idea is that it's sharing that risk, so sharing the gains or the losses, whichever applies at the end of the project. So if we can have the next slide, please, Jem. Thanks. So just to take a step back in terms of NEC, just as a reminder, our first clause is mutual trust. It's a typo there. It's mutual trust and cooperation, but it is a collaborative contract. So the option CD with the pain gain sharing fits in quite nicely with that. There are a couple of points that I want to raise later about how the pain gain is set and what you are all finding, which isn't always necessarily collaborative in my view, but we'll come to that. The early warning notice, EWN, we will come to that a bit later, but just so you note, the requirement is for both parties, so the project manager on behalf of the client stroke employer, the paying party, and the contractor, also of course in a subcontract, the subcontractor, the obligation is on both parties to issue the early warning notice. Broadly, it's if anything major happens, health and safety issue, programming change, cost change, other delays, other major issues. The difficulty from a contractor or subcontractor perspective is that there are specific financial penalties on the contractor or subcontractor for not issuing the early warning notice, whereas there's nothing specific for the project manager stroke client, save, of course, that they would be in breach of contract, and a breach of contract is a compensation event. We also have a risk register. Just be careful about that in the context of options C and D, but generally on NEC, because it's just stating it is just a register of risks. It is not allocating the risk between the parties. So be careful of that. Also be careful that it doesn't try to allocate risk, because then you will end up with a position where the risk register may say one party is responsible for a particular risk and the contract say another. So then you immediately have a conflict within the contract documentations. And it's not a problem. It's a challenge, obviously. The other thing is that it's called an early warning register in NEC4. So please don't call it a risk register, because then you end up with a conflict, because you have an early warning register and separately in the contract you have a risk register, and it's not, it's not clear what it is. It's not defined as anything. And you might think, well, common sense, says it must be the early warning register, but not necessarily. And finally, I just wanted to mention compensation events, which we've already touched on. The idea here is, obviously, it covers cost and extensions of time, and the money relating to those extensions of time. But the idea is, and it's part of the collaboration, it's connected to the early warning notices, no surprises. So, mainly that's, that the paying party, the client, does not want any surprises. So it's sort of almost the opposite to how the JCT was traditionally run, where the works would be completed, and then lots of claims for extensions of time, loss and expense, changes, etc., would come along, and the client, gets a bit of a shock at the end of the project. So, this contract is meant to counter that and stop it from happening. So if we can have the next slide, please, Jen. Yep, so I think we can move on from that. Thanks. Okay, so we're still looking at the target costs. So we know that the target goes into the contract in the activity schedule total or the bill of quantities total. The first point here, target must be as accurate as possible. So I did this as a seminar CECA North East, and it was interesting because the delegates there were talking about, how can you provide an accurate target, particularly if, for example, the site investigation hasn't been carried out and the target's set in advance of that. And we were having a discussion about it, and it seems to me that it's kind of similar in a way to how you would do your activity schedule, your fixed price on an option A, in that your target, there will be sort of levels of certainty. So if you've got all your site investigation, then your target can be pared down. If you haven't, then you're going to have to build a factor in of risk to cover that, particularly in view of what we tend to see now, which is when we have the pain gain sharing, and we'll see this later on, sometimes the way it's shared between the parties results in any pain, particularly once it's, over above a certain amount, any pain being borne by the contractor. So then that ends up effectively being a capped contract. Once the contractor, gets a certain percentage over the target, they know that cost is being borne by them. So, if you're trying to set a target that, hasn't accounted for detailed site investigation because you haven't got it at the time, I guess you're going to want to include some risk in there in that circumstance. And, that's sort of a long way around of saying, the second bullet point, if the target's set too early, it's difficult for the contractor. And, inevitably, they're going to try and protect themselves and increase the target. Ditto, problematic if the target is way too low, because ultimately the contractor somehow or other will try to claw back the money rather than having to suffer all the overrun. And from the client's perspective, whilst contractually this shouldn't be the case, it might be that resourcing of the project or quality of the project might suffer if the contractor is quite early on in a pain situation. And it's that last point, beware of the situation where the contractor is required to bear all of the pain share or all of it above a certain percentage. So if we can have the next slide, please, Jen. Okay, so just the very basics on your target cost. The first thing to be aware of is that the target, once it goes into the contract, is the target, but it's increased by reference to compensation events. So that is the purpose of compensation events in option C and D. So a little bit like on your option A, you have your activity schedule. In that instance, you might have additional works or compensation events that increase the cost of the works, and as soon as they're implemented, they effectively go into the activity schedule to increase the price and in some cases the programme. So sort of exactly the same thing happens here, except of course for this contract, the activity schedule is for the target cost. It's not how much is being paid as the works are progressing. We've kind of looked at broadly how the pain gain works, and we'll look at that in more detail. And very broadly, what happens is, and I've already alluded to this, through the course of the contract on a monthly basis, the contractor will make applications for payment as you would in any other project. And what you are claiming is effectively on a reimbursable basis, a very, very similar way to the option E contract. So by reference to the schedule of cost components, which states what you're able to claim, checks and balances, so that the paying party is only paying for efficient work, for example. So how it works is contractor is paid on that monthly stroke interim basis on a sort of reimbursable option E basis until you get to practical completion. Also throughout the course of the project, as we've seen, compensation events, once they're implemented, get inserted into the activity schedule to increase the target cost, or for option D, where we're a bill of quantities, into the bill of quantities to increase the target cost for an option D. So at practical completion, the project manager makes their first assessment of the pain gain share and the first payment resulting from it. It's the first because it's a temporary one, because you can't finalise it until after the defects period. When particularly under NEC 4, a final account will be being resolved between the parties. So basically, the project manager makes an assessment after practical completion calculates the pay and gain and effectively makes a sort of interim type payment to the contractor on that basis, finalises it after the end of the defects period. So that all sounds very simple. We'll look a little bit later on about some of the problems that you may face when things don't quite go right. But before that, I just want to refer to this Doosan, Ompure and Interserve case. If you look at it, it's actually a joint venture agreement. It's not an NEC contract, but it adopted all the NEC option. I'm pretty sure it was an option C clauses. So it does apply to an option C stroke option D situation. In effect, what happened here was the parties were in a joint venture, but effectively regard Interserve as the contractor and Doosan the subcontractor, or Interserve as the developer, the authority commissioning the works, and Doosan the contractor. They got part way through the contract on a pay and gain option C basis, and it very quickly became apparent that they were going to be in a pain situation at the end. But as I've said, the contract says you make your first assessment, your pay and gain payment, whichever way the payment is going, at practical completion. Interserve seemed to be getting nervous about this, so they made an allocation prior to completion. The matter went to court, and the court said no, it's pretty clear under the contract, and it's pretty clear under NEC C and D also, that the first allocation of the pay and gain share is at practical completion. Now, when you're in pain, that's problematic because the contractor in a contract scenario, typically will have been paid money, which everybody knows will ultimately have to in part or all, be paid back to the paying party. So that's the nervousness. The contract, as I've said, is clear, but what we are now seeing as a result of this case, I think, is that paying parties are altering the contract to allow for a pay and gain adjustment throughout the contract period. Now, if you're the contractor and you're happy with that, then that's fine, particularly if it's a pay and gain alteration, because you may find that in your interim payments, you're getting a gain share. If it's in a pain situation, in reverse, you may find that you are having to pay money back through the life of the contract. What you need to be aware of if you're a contractor or a subcontractor is that the contract doesn't just allow a pain share to be altered, because that means the money's travelling one way only from the party doing the work, the contractor or subcontractor and a subcontract, up the chain. There's no facility to pay it the other way until you get to completion. So just be careful about that. It would be a Z clause in the contract, so you just need to check it when you're reviewing your contracts. So if we can move on to the next slide, please, Jen. Okay, so I think we've covered a lot of, or some of this actually. So first bullet point, we know that your target is set in your activity schedule or bill of quantities for option C, D respectively. The next point, which we haven't covered, is where is the pay and gain sharing mechanism? So if you're in a gain situation, so the cost of the works is here, 8 million, the target, including the compensation events, is 10 million, you've got 2 million to share, wouldn't that be nice? Where is that detailed? How do we share that £2 million between the two parties? Well, it's set out in the contract data part 1. So that is the bit that the paying party, the developer, the party commissioning the works completes. So when you are reviewing your contracts, you need to review that to make sure the percentages work for you, because you might think, well, it'll all just be shared 50-50, but that is not the case. And it's not even that simple, and we'll come on to that in a minute. I think I've already covered the target prices adjusted by your compensation events. Yes, I have, because we talked about it being implemented in the same way as options A and B. So the fourth bullet point, this just kind of puts a bit more meat on the bones of the process through the interim payments. So up to practical completion, the contractor is effectively paid what I refer to as actual cost, but it's called in the contract defined cost. So paid defined cost less, so that's minus the disallowed cost plus the percentage fee or the fee percentage. The defined cost, so I call it actual cost, it's sort of a base cost. So this is, as I've already said, by reference to the schedule of cost components. It's very specific as to what can be claimed, and it's effectively looking at, for example, the cost of individuals who are working on the project. What is the cost of that individual to the business, so the contractor or the subcontractor. So obviously the salary, the tax paid for them, including national insurance, company car, health insurance, cost of training, cost of holidays. So all these costs are added up to kind of work out basically a daily or weekly cost for each individual. Quite cumbersome, yes, it can be. And as I've said, we're looking at that in more detail in March, if you're interested. And it's relevant to far more than just options C and D. It's how we quantify compensation events under options A to D. So, it's really important pretty much for every contract for NEC. So that's the sort of base cost minus disallowed costs. We'll look at this in a bit more detail, but it's basically wasted cost. So costs where the contractor, for example, has been inefficient. Why should the paying party, pay for a contractor to be inefficient? So, that can be deducted from disallowed cost. And then we add the fee percentage or the percentage fee, which is basically very broadly the overhead and profit, because of course we've seen from the defined cost that just covers the actual cost of the people, the material, the equipment. And of course most businesses, contractors, subcontractors, want to make a profit, yeah, and have certain overheads which need to be covered in addition to making a profit. So yeah, the pain gain share is the difference between the prices. So that is what the target is called in NEC, and the price for work done to date. So that is that actual cost as the work goes on. So if we can move to the next slide, please, Jen. I think, yeah, we've covered all that, so we can move to the next slide. Okay, so this is just I was saying today, I must have prepared these slides about 10 years ago, and my first option C contract was actually for a contractor who had built a house in Mustique, and sadly we didn't get to do a site inspection, but that kind of predated preparing even these slides. And my client basically said, look, I'll look after the pain gain sharing. You just deal with the legal aspects of things. And then at some point I thought, I'm going to need to get into this. So basically this is just me trying to sort of have a sort of mental visualization of how this works. So the target price is called the prices. So it's basically the activity schedule or the bill of quantities, depending on whether we're on option C or D, plus compensation events. How is that calculated? Schedule of cost components plus the fee. equals the ultimate target price at the end of the contract. So I think the key thing is to remember that the target price starts off as a certain figure in the contract, but it is fluid to the extent that there are compensation events. Now, I said a couple of slides ago that, this is all, sounds all very kind of reasonable and easy to operate. The difficulty on a practical level, and this applies to all of these pain gain contracts, not just the NEC, is that if you have your target, which is sort of increasing or not, depending on, how many compensation events there are, and you have the contractor carrying out the works and being paid as they go along, in order to work out the pain gain at practical completion, you properly and accurately, so that both parties are happy with it, you have to have a situation where at practical completion both parties agree the target price stroke revised target price. In my experience, that's quite rare, because through the course of the project, quite often there will be disputes about, is this a compensation event? How much is it worth? And obviously that will impact on the target price. So the most likely scenario is that you will have a contractor who says the target price is here, and a paying party who says, no, it's much lower than that. It's somewhere down here. And obviously you can't finalise the pain gain until you have a finalised agreed target price. So it might be that, if you can't reach an agreement, then, you're going to adjudication to get that determined. So if we can have the next slide, please, Jen. So this is the instalment payments. So we've got, as we've seen, defined cost minus the disallowed cost plus the fee percentage equals the instalment. So it's the price for the work done to date. And exactly the same point here applies. Probably less scope for disagreement, but, you might get to practical completion and the pain gain is being assessed. But unless, the price for the work done to date is agreed between the parties, there is never going to be agreement as to the pain gain sharing. So again, that might have to go off to dispute resolution, i.e. to adjudication, to get resolved. So if we can move to the next slide, please, Jen. Yeah, so we've covered that. Sorry, these slides, I think the key point here is it's just doing it in more slide format rather than charts, but it gives you the clause numbers. So defined cost is defined, so it's sort of explained in clause 11.2. So it's subclause 23 for NEC 3 and 24 for NEC 4. So if we can have the next slide, which I think covers disallowed costs. So you can see there the same arrangement regarding the clause number, and just a little bit more detail here as to what some of the items that are disallowed costs. So bear in mind, these are items that the project manager can deduct from the contractor's defined costs. So, the first one is, sums that aren't justified from the contractor's records. Now, that makes sense. So, if you're talking about an claiming the cost of an individual on site, we talked about the schedule of cost components, how we would work out their daily or weekly rate. But we then need a sort of a timesheet basically to explain what they have been doing over the week, whatever period we're talking about. If we don't have that, then I would anticipate that the project manager is going to use this clause to make deductions, not pay for people, unless it can be shown that they're contributing valuable work to progress the works themselves. So the next one are sums not due to the subcontractor, could be for similar reasons. The next one, and we've mentioned early warning notices, EWN, money incurred or claimed by the contractor, but they didn't give an early warning notice about something or followed a procedure that wasn't correct, project manager can make deductions. The next one, I think we would all agree, is a valid one. The cost of contractor or subcontractor remedying defects, shouldn't be able to claim payment for that. And finally, contractors' adjudication preparation costs, and that's simply because the rule under NEC is that each party bears its own costs for preparing for an adjudication, and that's just how the risk is allocated. So hopefully that gives you sort of a feel for disallowed cost, and that it's not, as I said at the start, well, this is like a reimbursable, so we just claim for however many people we have on site, and we'll get paid for it. It doesn't work like that. The monthly interim payments can be interrogated and sums will be deducted. So if we can move to the next slide, Jen, which I think should be the fee percentage. Yes, that's logical. So yeah, as we've shown, it's the overhead and profit, cost of your insurance, and a few other miscellaneous costs. So if we can go to the next slide, please. Yeah, so we've covered all of that, so we can move on. And this just is a summary of the defined terms, so that's why they've got capitals, and again the clause referencing, as we've already covered. So we can move, we don't need to go through those, we can move to the next slide. Okay, so we are now at the bit that I don't like, but I managed to get it right, I think, this morning. So this is the process for calculating the pay and gain share. So you're at practical completion. It's the project manager's job to do the calculations, but I would imagine if you're a contractor or a subcontractor on a subcontract, you'd want to check them. So we know that we are looking at the comparison between where we are with the target cost, because it may have been increased by reference to compensation events. We know that we might not have a final agreed figure, so the project manager will likely be calculating it on their assessed figure, which might not be as good for contractor or subcontractor and a subcontractor as their figure. So that might be sort of work to be done later in terms of trying to resolve that issue, or as we've talked about, looking to adjudicate on it. We also know how much at practical completion the contractor has been paid so far. Again, we know that the parties may not be in agreement with that, but the project manager will be looking at the sum that has been certified and paid. The project manager then needs to work out whether it's in a pain or a gain situation. So is the sum paid more or less than the target? If it's more, then we're in a pain situation. If it's less, we're in a gain situation. And then where we are, whether it's pain or gain, the project manager has to split that pain or gain into increments based on the contract data part 1 and how the percentages are split to work out how the pain gain works and what the sum payable is. So ultimately, the final bullet point says if you are under target, so you're in a gain share situation, that will result in a situation where the paying party, so the developer and the party who's commissioned the works, will be paying the share that is due to the contractor to them. If you are in a pain situation, then effectively the contractor has been overpaid, so they will be paying money back to the party who's commissioned the work. So that's a really odd situation for everyone concerned. It's odd for contractors and subcontractors because it's not usual for them to be in a situation where they have more money than they are entitled to. And it's also a very odd situation for particularly a developer or public body to be in, because again, they're not usually in a situation where they are trying to recover money. So it's slightly unusual all round, and I suspect it could be challenging for the party wanting or trying to recover money. So if we can move to the next slide, please. Okay, so that just repeats what we've looked at, but gives the clause numbers. So we can move on. Lovely. So this just reproduces contract data part 1, how the pain gain is dealt with. So you can see here, it shows the share range on the left and the contractor's share percentage on the right. So we are going to see a worked example, which is easier for me to understand, easier for me to explain. But this is where it shows how you've got to identify the share ranges. It's not just a case of, it'd be far easier if it just said, look, we split any gain 50-50, we split any pain 50-50. That would be so much easier for the lawyers in the room to understand. But that's not how it's dealt with. Obviously, you could have it like that, but it's not. Just note as well, the second bullet point that requires the contractor to prepare forecasts of its defined costs. So effectively, you're forecasting in advance. So typically, I would expect that to coincide with interim payments. So if your interim payments are monthly, I would anticipate that would be monthly. So if we can right, so if you can just sort of hold the thought of that first bullet point. So we've got our share range and the contractor's share percentage, because the examples that I'm going to take you through relate to that. And it's kind of really important to kind of fix this in your mind so that you can see how it works. So if we can move to the next slide, please, Jan. And we've covered that, so we can move. If we can move to the next slide. Yeah, so this is what I want to go through. Don't worry, it looks worse than it is, I think. So all I'm going to take you through is this example 1, which is pretty much in the middle of the chart. I'm not going to take you through examples 2 and 3. This isn't my own work. I, credit this to the guidance notes in NEC. So I would recommend that you use them. I've just converted it into a chart. So what we have, starting from the left-hand side, we have the contract data in the slightly darker green column running down, and you can see the share range. So this replicates that left-hand side where we looked at the share range. So in this one, we've got less than 80%. And obviously, because it's contract data part 1, the paying party will input this. So it's up to them to consider it. But of course, subcontractors need to consider it as well, because it impacts on what they will recover. So we've got here less than 80%, from 80 to 90%, and this is the increments that I'm referring to, from 90 to 110%. So basically, you'll all know this, I know, but 100% to 110, that is the gain. Sorry, that is your pain situation. When you go over 100% of your target, you are in pain. So 100 to 110% is your first tranche of pain share. And then greater than 110%, is again a pain share. So then the next column, again, it's contract data. So this is the right-hand side of that contract data entry that we saw where it said the contractor's share. So this is what the contractor gets. So if you have a tranche, if they come in less than 80% of target, they get 15% of that tranche. So if we move along, we are now, so the columns 3 and 4 are our example. So we've got the total of the prices is £100,000. So that's, sorry, the prices is £100,000. So basically that's our target. Doesn't matter what it was in the contract. It's the target impacted by the compensation events. And of course, for my example, to keep it simple, we are assuming that both parties agree that the target, the prices, is properly £100,000. What we know for example 1 is the price for the work done to date. So the total of all those interim payments is £75,000. So I like this one because happy days. We're in a gain situation because the cost of the work has come in under the £100,000 for the target. And you'll also notice that the target is a very handy 100,000. So it means that the percentages are a lot easier to work out. So our example 1, we've got £25,000, where what I've called saving, but it's effectively a gain share. So that's the difference between what the works have cost and what the contractor has been paid, that's 75k, and the 100,000 target. We've got 25k to share between the parties. So it would be nice if it was just shared 50-50, but that's not how it's done because we've got the contract saying how it's done incrementally. So for anything less than 80%, so for our 75,000, it's 5,000, the difference between 75 to 80,000. So we've got 5,000 in that 1, 2, 3, 4, the 5th column. You can see it says 5k. That's the 75,000 to 80,000. So that's the 80%. We know that in the next column, the second column along, it says 15%. So the contractor gets 15% of it. So it gets 0.75k for that increment. You then move down from the 80 to 90% because we're working on a target of 100,000, which makes it easy. We know that that's 10,000. So in that 1, 2, 3, 4, the 5th column, we've got £10,000. And we know from the second column along that same line that the contractor's share is 30% here. So it's 10,000 times 30%, 3,000. And then from 90 to 100% in our case is 10,000 again. So this is the 1, 2, so lines down, 1, 2, 3, 4, 5. So the one that says from 90 to 110%. It's quite difficult doing this on a slide. It's far easier in person. The contractor's share is 50%. So if you go along, we've got 10,000 at 50% is 5,000. So you can see that of the £25,000 to be shared, the contractor, based on these figures, gets 8.75 thousand, and the paying party keeps the balance. So that's what I'd wanted. So that's how it works. So, you know, it's done incrementally. So you do need to be careful about that because I had, I mean, even last year I had a project manager who just calculated it effectively by saying, well, it's 25,000. So it all goes into the 50% for these purposes, which wouldn't have been correct. The other thing that we need to be careful of is, as I say, reviewing these percentages to make sure that you are happy with them. In particular, what you tend to see is what we've got here. So, you know, the gain share for the contractor isn't very high. If there's a, you know, if the contractor does really, really well and comes really well under target. But what I'm also seeing more and more is a situation where the contractor has to bear all of the pain once the contractor gets into a pain situation, or maybe, you know, 110, 120% of the target cost, which, yeah, I don't quite understand, you know, what the argument there would be. I can see an argument for saying, well, the contractor's the expert in this, so, you know, it should be able to calculate a target cost properly so that they don't go into severe, you know, pain sharing. But equally, you know, that's not always the case. Contractors, you know, when they're tendering for works, don't often get a chance to provide detailed targets, etc. And also, of course, it's effectively capping the contract. So in some ways, you know, it's arguable that the contractor's getting the worst of both worlds. It's not getting a fixed price where it might have the opportunity to make a lot of profit on a project, but it's not getting a proper pain gain sharing contract. So that's just something to think about, and, you know, a trend that we are seeing quite a lot. So if we can move on to the next slide, Jen, please. Yeah, so we've covered all of that, so we can move on. Yeah, so I think that's possibly pretty obvious, but compensation events do on occasions reduce the contract price if it's a reduction in scope, so that would effectively work for the target cost. We've gone through this, so we can just skip that one. Yeah, we've done that. Yeah, done that. I did exactly the same this morning, talking too much on individual slides. Yeah, we've sort of briefly covered forecasting, so that's fine if we can move on. Yeah, yeah, we've covered that, so that's all fine, and that one. And oh, that's just a repeat slide. Apologies for that. And that one. Oh yeah, so I think the final point is just beware of the termination provisions. So if you terminate, and realistically, termination is more likely to be that the client is terminating the contractor or contractor terminating the subcontractor's employment. But either way, you then still have to do a pain gain assessment. But it gets even more complicated because, of course, the pain gain assessment has to be based on the works that have been completed as at termination. So you have to have some way of apportioning the target cost to represent the works that have been done, so that the works that haven't been completed aren't included in the target. Otherwise, the pain gain isn't going to work properly. Now, you know, in theory, that's all fine. It just adds another layer of uncertainty and another kind of scope for the parties to disagree on, particularly if it is a termination scenario. But again, you know, this isn't unique to the NEC option C and D. It pretty much applies to all pain gain sharing contracts. It's just a point to be aware of if you're entering into an option C or D contract as opposed to A and B. It just makes the calculations of the pain gain more problematic. So I think if we can move to the next slide. That's it. So yeah, in conclusion, you know, I think hopefully you understand that the options C and D, they're a pain gain mechanism, but they use A and B and E in different ways to get to the pain gain. Ensure you're not taking all the risks when it gets to a pain situation, in terms of the percentages, but also that when there are gains, you know, the percentages, you know, are being shared fairly between the parties. And then I suppose be careful when you're setting your target cost, to ensure that you know, it is right for the project. And as I said at the start, you know, if this isn't a project where, you know, it's been looked at in detail, it's been designed in detail, etc. You know, there's a likelihood that things will change. So, you know, some wriggle room might need to be factored into the target as well. So that's everything. We've got 2 minutes for questions, which is pretty good for me, to be frank. Happy to deal with any questions, but I appreciate if people need to get off, that's absolutely fine.